Today we wanted to talk about the current event. We want to talk about the economy globally, along with the current situation about the virus, the global pandemic. So today I do not want to move on to the course material. And let's just talk about the situation that we are dealing with currently, okay? And let's learn something from the current situation. And I remember on January 21st, so that was the Tuesday of the second week of this semester. And at that time, I told you that the Chinese President Xi Jinping acknowledged one day before, that was on the 20th January, about the existence of this coronavirus, and at that time I would assume that barely any kind of the news media or the professor would talk about this issue. I bet I was the first, to talk about that. And then 2 days later, that was January 23rd. That was a Thursday, and I talk about the lockdown of the Wuhan, and the reason I was able to bring this issue into our classroom discussion at a very early time, it was because about starting the beginning of the January, I already read something alone about this potential epidemic at that time in some news resources from in Chinese news media and Taiwanese news media, etc. So because I had the first-hand experience with the 2003 SARS, so I paid particular attention to this particular issue, and so to me this is a very important thing, and I think that we can learn quite a lot of things by having this discussion and throughout this entire process. And unfortunately, that this novel virus turned into a pandemic, which just beyond my initial expectation. And at the time we talk about, at that time I still use the name of Wuhan coronavirus because that was the official name also used by Chinese authority at that time. And the stock indices at that time for SP 500 was like 3,220. And then the US stock market had remained at a very high level and even keep on going up even when Wuhan was locked down. And this whole situation started to shift after Italy was on the brink of a collapse, and the US stock market started to react. And at that time I told you that this relates to one of the stylized fact that we learn about in financial economics. We call that home bias. Home bias refers to that we react more strongly to the things that are closer to us. And Italy and China are a whole different kind of concept, and to people who live in the United States. And one is 12 hours difference, and the other one is probably only 6 hour difference. So we react more strongly to the thing happen that are closer to home. So it's not surprising that the stock market started coming back in February, and SP 500 index went from 3,380 all the way down to like 237. okay, about a month ago. So during these 3 to 4 weeks of the extreme rapid downturn, and the stock market lost about 35% of the market value. And be honest with you, in my life, I've never seen anything like this in the United States in terms of how fast and also at this magnitude that the stock market is coming back. So it showed that the market was panic. And after that, we have some rebound, and it's kind of moved relatively horizontally, and this is kind of a typical, we call it correction. And after a big drop, there will be a consolidation, and usually the volatility is going to gradually the volatility is going to kind of calm down a little bit as we digest this kind of information. And after a certain period of time through this consolidation, then maybe there will be a breakthrough, either a breakthrough upward or downward. We don't know. But most likely that we will be in this bear market for some period of time. Typically, a bear market will last about 2 to 3 quarters. And we do not know, okay? I do not have a crystal ball. I cannot tell you exactly how long this thing will last. But based on the prior experiences, usually take about 2 to 3 quarters. So it will we still have a couple months to go to go through this volatile time period. And during the meantime, if we look at the global currency, and of course, when we talk about currency, US dollar being the most important currency, there's no doubt about that. And over the past about 2 months, we have seen that US dollar have been strengthened. The US dollar index, that's a DXY. You can Google DXY and find the chart. And over the past 2 months, it went from roughly about 97.5, and today is about 100. It was 102.6 just a few weeks ago. So it kind of went from 97.5 kind of to 102. Right now, kind of come down to 100. So it's kind of upward trend. It shows that the US dollar has been appreciating over the past 2 months. And of course, that means that the majority of currency out there, they have been depreciating. And this says something about that US dollar being the most reliable currency. And during this kind of volatile time, a lot of people want to wire their money to United States. As a result, that there's a strong demand for US dollar and leading to the appreciation of the US dollar. So that's one way that you can make this interpretation. And the second possible interpretation is that the US economy, although currently we are suffering, but relative to many other economies out there, our economy is still by far structurally sound and strong. And after this shock, and it's quite possible that we will be able to recover much nicer, in a much nicer way than many other economies. Okay, and the US dollar appreciation reflect this possibility. So that's another way to interpret why the US dollar has been strong. And in addition to US dollar, Swiss francs has been very strong. And we talk about this, that usually Japanese yen and the Swiss francs are the other two, the so-called safe harbor currency. And whenever there is a global uncertainty emerge, that those are the kind of currency that we tend to see have a better performance. So that's on the currency front. And there another major currency, that is Chinese yen. Chinese yen has been weakening a little bit over the past 3 months. So right now the exchange rate is about 7.1, about 7 to 7.1, and we have seen a little bit of weakening of the Chinese yen, and this weakening currency for Chinese yen has something to do with the first 2 months of this year. The trade surplus, the Chinese trade surplus, have dropped from roughly about $40 billion US per month, the surplus of $40 billion a month, all the way down to about $3.5 billion deficit for the month of January and February. So here we are talking about that over the past 2 months, China is running a trade deficit, not surplus. In the past, it has a constant big surplus, but that was not the case for the first 2 months of this year. And the reason was because the China had been locked down starting January 23rd. So it was not possible for them to engage in large-scale industrial output and export that to United States or export those goods to Europe zone. As a result, that their export dropped substantially, and they still need to import like oil and food, etc. As a result, that they have a deficit. And as we have learned in the class, whenever a nation has a deficit, that's going to put tremendous amount of pressure onto the value of that nation's currency. So currently, the Chinese yen has been a little bit weak, and one of the reasons is because that they are running a trade deficit. Another piece of information that I want to talk about is the 10-year Treasury yield right now is 0.75%. And 0.75% is far below 1%. That means that when you lend the money to Uncle Sam, each year you do not earn more than 1%, only 0.75%. So we are living in an era where the interest rate is almost zero. Okay, we are living in an era where the interest rate is almost zero, and so it is kind of a necessity from Federal Reserve perspective. In the United States, we would need to have an extremely low interest rate in order to inject enough of the liquidity and also provide the least possible level of a cost of capital to help our corporation to survive this particular shock. And this kind of monetary autonomy is possible in the United States. Okay, it is because when we talk about impossible trinity, the two things that in the United States choose is, one, we want to have this autonomous monetary policy. Another thing is that we want to make sure that we have free capital flow. And of course, there's one thing that we have to let it go. That is that manipulating or having a fixed exchange rate. So our exchange rate, the value of US dollar may goes up, may come down, and we rarely intervene on that front. But that is not the case when we talk about the situation in China. The impossible trinity pair that China has been traditionally adapted was that they wanted to at this particular moment they wanted to maintain a certain level of the exchange rate for the Chinese yen, and at the same time, at this time being that they want to make sure that they have they kind of give up on the exchange rate, okay, the capital inflow and capital outflow, and during this unusual time, so they don't have a lot of the freedom, being free up to working on the monetary policy. So unlike in the United States that we have been act aggressively lower the interest rate, in China the interest rate, although it's have been bring down, but not have been bring down into in a aggressive enough of fashion. So without the monetary policy have been entirely tiered for improving the economic output, and the GDP growth have been suffering in China, and of course at the same time we understand that a lot of information come out from China has not been transparent. So there are official number of the GDP, unemployment, etc. But those numbers are not very reliable, and based on, I mean, I do not have a true number. No one has those true numbers, but it's quite likely. It's quite likely that the current GDP output in China is probably 20%, 25% lower than say a quarter before. So the Chinese economy right now is under tremendous amount of pressure. Our economy is also under tremendous amount of pressure, but the situation in China is probably even worse. Okay, so that is the current economic situation from the stock market, from the currency, from the interest rate, from the GDP growth perspective. And then there's one important thing I think that are very relevant to you, because many of you are graduating senior. That would be the job market. And unfortunately, right now we have skyrocket unemployment claimed, and there are estimates out there talking about that the unemployment rate may show up to say 20% or around 20% in the next few months in the United States. And so for those of you who haven't secured a job, and surely that would make your job search much more difficult. And so I want to give you some perspective and try to give you some of my thinking. Okay, and during the year 2009 and 2010, some of our alum, okay, some of our students graduate from those 2 years are dealing with a very similar kind of situation. The job market was not strong, and finding an ideal job was not easy. But what I have found was that some of our students, and they are really creative in the sense that they somehow managed to find a job, although those jobs are less than ideal, but they were finding a job in the profession that they are really interested. So they find a job and they hang on there for 1 or 2 years after the market had been improved in year 2011, 2012. And then with those 1 or 2 years of the job experience in that industry that they're really interested in, and they move on to a much better job. And for example, I have a student who used to work for a real estate company in Baltimore. I think he worked there for like 1 or 2 years. After the job market had been improved, and he quickly went on the market again, and eventually, right now he is working for Barclays. Okay, and Barclays is a world-class investment bank, and I just wanted to give you some perspective. Maybe the first job is not very ideal, but as long as you work in the industry that you're really interested in, and then hang on there for 1 or 2 years and learn something, put that experience onto your vitae, and until the job market recover, then that would be your opportunity to move on. and actually would be well prepared for the challenge, for those good job, and the challenge associated with those good job down the road. So I really want to encourage you that keep your hope high and being resilient and go through this difficulty. And the first job is always difficult to secure. And go on to get your first job and do good work and wait until the right timing. Then you will be able to pursue whatever that you have always want to pursue. That would be my advice for this difficult time. And also another thought of mine is that this economic downturn, although look very, very severe, but I think this economic downturn, okay, would last a relatively short period of time compared with the 2008-2009 financial crisis. The 2008-2009 financial crisis was a really severe one. And my conjecture is that this pandemic, although it looks scary, but it will not as long lasting as the previous one. And the reason is that the reason is that the 2008-2009 financial crisis is due to an endogenous structural issue within our economy, and that is driven by the excess leverage. I mean that before 2008, that we have been borrowed too much of the money, so we will need to do the so-called deleveraging in years of 2009, 2010, 2011. And deleveraging was no fun. It just means that we would need to sustain GDP decrease, and we would need to have unemployment because the company had been downsized, etc. And those took a long time. And this time around, before the pandemic, our economy is still relatively healthy, and we do not have big issue in our banking system or financial capital market system, etc. So this time around, once this pandemic goes away, and my conjecture is that we should be able to go back to some degree, some sort of normalcy relatively quickly compared with what we have been went through in the 2008-2009 financial crisis. But still, it will still take a while. But I think this time around that it will probably won't take that much long period of time. And right now our economy tends really fast. At one particular point in time in the hopefully near future, most likely there will be a rebound. And then hopefully that there will be more like a V-shaped kind of a recovery. And our ability to recover in a V-shape will depends on how long this pandemic will last. The longer the pandemic will last, then the probability of a V-shaped recovery will be smaller. So that's still some sort of uncertainty that we will need to deal with. And for some of our students who are from China, and the recovery path of the economy in China probably would be different from the economic recovery path that I just discussed for the case of the United States. And the reason is that the China currently has a structural issue very much like we have in the United States before 2008 financial crisis. That is that currently there is too much of the debt in China, and a lot of those debt are not very high quality, and there is a good chance of defaulting, and also the banking system in China is relatively fragile, and the shadow banking system in China is pretty dangerous. So for those of you who has asset exposure in China, that means that you have asset in China, you may need to pay particular attention about the banking situation in China, particularly because after a few months of not being able to have a normal level of the economic output, and currently there are firms that quite many firms in China starting to fail, and that is going, and those failed company maybe borrow some money from regional bank, and those regional bank right now has a balance sheet that is not very high quality. So pay attention to the stock prices of those banks. Whenever the share price drops suddenly, if you have money, if you have a saving account, you have deposit in that particular bank, I think it would be wise to go ahead and withdraw your money in a timely manner, or you may want to diversify your saving across a larger number of different banks. And some sort of diversification at this time being seem to be prudent as well. Well, if you have the asset exposure in China, and I have been following the economic development in China over the past many years. I have been relatively pessimistic about the development of the economy in China for a few years, and right now I'm really worried about the economic situation in China, and the United States economy in this pandemic. There's a chance of the V-shaped recovery, but in China it's probably more like a L-shaped kind of recovery down the road. So that's something that I want to share my thought, and of course I'm just a professor and I follow the publicly available information. I used to be a practitioner, and so I look into the data. I have some experience, so I bring this kind of discussion into the classroom, but a lot of my assessment could be incorrect. So I wanted to qualify that this is academic discussion, and I do not endorse, I do not suggest any kind of investment strategy based on academic discussion. And we will need to have this kind of discussion because this is what university is about. But when you want to implement this into your investment strategy, and you need to see advice from certified investment advisor instead of following a professor's classroom discussion. So that would be the qualification that I wanted to put into today's discussion. And so this is it for today, and I think that from time to time we ought to spend a little bit of time on current event and then follow through this situation. Yeah, thank you.